Hello everyone, I am Niket Shah, CIO at Motilal Oswal Mutual Fund. Let me take this opportunity to give you a brief understanding about the market outlook and the global scenario at this point in time. If you look at the last month itself, and if you look at our fact sheet, you would have seen that we were actually running at about 20% plus cash on most of our portfolios. And the reason is we did expect the earnings growth to be extremely weak in the last quarter. If you look at the first quarter itself, Nifty earnings growth was only 7 to 8%. Our anticipation was the second quarter would be about 2 to 3%. As we stand, it has actually come to about 1% at this point in time. And we actually predicted that there is significant amount of slowdown in the economy that we are seeing, which will be reflective in corporate earnings in the second quarter. This has actually played out, and hence we have seen more than 10% correction on Nifty and more than 12 to 13% correction on mid caps and small caps respectively. We have made most of this by allocating large amount of cash that we have. It's now completely deployed. We are now seeing significant signs of improvement in the economy. Let me give you a brief understanding of where we are right now. If you look at the first 4 months of the year post-election, the central government capex was down 18%. State government capex was down close to 8 to 10%. The earnings growth was extremely weaker. The tax collection was extremely weaker. The power demand was in single digit at about 6 to 7% versus double digit earlier. And it looks like there was significant amount of slowdown which is here to sustain for a longer period of time. Having said that, what we have started to see, the government capex has started to revive. The government has got into action after 4 months of the election. We are starting to see state capex coming up in a big way. In fact, last month itself, we are seeing 21% growth in the state capex. We are seeing actually one of the best festive season at this point in time. So whether it's any part of the consumer discretionary space, whether it's fans, whether it's AC, whether it's appliances, whether it's two-wheelers, we are actually seeing record growth, which is probably the best ever festive season that at least I have witnessed in the last 4 years. At this point in time, we are now running with extremely low cash of about 25 basis points only versus 20% earlier. Let me take a moment to speak a bit on the global scenario. We have recently seen a conclusion of the US election where Mr. Donald Trump is now being the elected president for United States. And we all know the key agenda items for Donald Trump. We do know that he is likely to put more tariffs on China. We do know he will be pro-growth. And we do know there will be tax cuts on US enterprises. All of this augurs extremely well for the US market and in turn the international market and Asian markets across the world. We do believe there will be a significant amount of rally in India as we go forward, and the global scenario continues to remain extremely robust now with a guy like Donald Trump being in charge of the US government. Let me talk a bit about the sector rotation and why our funds have done so well in the last 4 years. If you look at most of our funds, whether it's a mid-cap fund, or the flexi-cap fund, the multi-cap fund, large and mid-cap fund, all the funds have actually seen alpha creation over the last 4 years. A large amount of credit will actually go towards our sector selection and our theme selections. In the last 4 years, we have actually picked the right themes and right sectors at all points of time. And within these themes and sectors, our stock picking was absolutely spot on. We've actually spot on the highest growth stock within that sector or theme, and which has actually resulted in very high profit after tax growth for all our schemes put together. If you look at the last 3-year data itself, most of our schemes have actually done more than 35% plus earnings growth on a reported basis. Okay, let me talk to you about the sectors where we are seeing very high growth and sectors where we are seeing slowdown in earnings growth. We strongly believe that the market in the last 3 to 4 years, which was extremely broad-based with most of the sectors doing extremely well, is now likely to become extremely polarized. Given the fact that earnings growth is quite slow, there are few companies and few sectors and few themes where there is high growth. Let me now talk to you about some of our high growth funds. If you look at our mid-cap fund, has delivered phenomenal returns over the last 3 to 4 year period. If you look at the earnings growth of the fund is today at about 36% CAGR for the last 3 years. We also believe our business cycle fund is rightly positioned. So let me finally conclude with the sectors that we are very, very overweight and bullish on. We are extremely overweight and bullish on pharma. We are overweight and bullish on IT, manufacturing. Within manufacturing, we continue to like wires and cables businesses, and we are slightly underweight on defense and capital goods now. We continue to remain extremely excited about the consumer discretionary space, where again we are seeing a lot of startups growing at very high rate. I want to thank all of you for the trust that you have shown in most of our funds. And I hope you will continue to support us in our journey as we take to newer heights. Thank you so much and happy investing.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.